Hi, everyone. I'm David Silver, CEO of Instrumental Wealth. And joining me today is Drew Allen, Senior Wealth Advisor. The One Big Beautiful Bill was recently signed into law on July 4th, 2025 by President Trump. There were a heck of a lot of changes and opportunities within this bill. One of those is regarding short-term rentals and cost segregation studies that can be used for depreciation expense. And so, Drew, let's unpack this a little bit further as to what the law says and the key provisions with it, and where clients can take advantage of this in their tax planning.
Yeah, Dave, great topic. Let's unpack what the One Big Beautiful Bill means for short-term rentals. So again, President Trump passed the One Big Beautiful Bill on July 4th, 2025. And there were some key provisions in there regarding rental real estate, specifically for short-term rental real estate, an active trader business. So three major things we want to cover today are bonus depreciation. How does that affect a short-term rental, and how could it be impactful to someone's tax return? The second thing is qualified business income deduction, known as QBI. And third is some tax strategies. Specifically, we're going to focus on cost segregation analysis. So let's walk through those. So let's start with bonus depreciation. So if we back up a little bit to 2017, when the Tax Cuts and Jobs Act passed, bonus depreciation, things such as refrigerators, furniture, things that you would equip a short-term rental with, had 100% bonus depreciation where you could write that off. That slowly had a phase out, and up till this passing of July 4th was at 40%. So where's this significant? If you go back to January 19th and go forward in 2025, that's now back to 100% depreciation. So if you own a property and you have to buy some equipment for it, some furniture, you can now write that off, which is a big deal versus spreading it out over multiple years. So that was a key provision. The next key provision that we want to talk about is QBI, or qualified business income. Now this is a little bit trickier in that it needs to be an active trader business or classified that way. So it does have to be an active business. It couldn't be a passive income strategy where a lot of people say they want to buy a short-term rental and do an Airbnb as passive income, which we hear a lot about. QBI only applies in an active situation. So we can coordinate with your CPA. There's a lot of rules around how does a short-term rental become an active trader business, such as how many hours, and is it your main line of work, and how much are you engaging in that practice? So again, a lot of nuance there, but can be a big savings because QBI is a 20% deduction on that income, which will save quite a bit in tax dollars. And again, there's a phase out just like in any active trader business with QBI. So we would coordinate again with the CPA, but super excited that that is now permanent. And there's no phase out on it. So that was a big pass and a big deal for short-term rental property owners. So the third thing we wanted to cover was some tax strategy specifically around cost segregation. And what is cost segregation? If you're not familiar, normally assets are on a 27.5-year depreciation schedule in the real estate market. And then other assets are on short-term depreciation schedules, such as a refrigerator or furniture, what we just spoke about. So what a cost segregation analysis does is reclassify some of those. And what does it mean and how do you do it? Well, you do have to hire a firm to do that analysis. They would go in and separate those things that could be reclassified. So as an example, if we bought a $1.2 million property and we had a cost segregation analysis done and completed, it was certified, and they found $400,000 worth of items that we could reclassify to short-term depreciation. Now coupling that with bonus depreciation, you can get a very large tax deduction in year one as a short-term rental property owner. So as you can see, that could be a very large deduction against income. If it's active, again, coordinated with your CPA, that might cross over and offset other income, which can be very, very helpful, which is why you see a lot of folks buy real estate. So again, the One Big Beautiful Bill here did a lot of things in the short-term rental market. And the three things that we covered just again were bonus depreciation, qualified business and income deduction, and the tax strategy of a cost segregation. So again, really excited. A lot of our clients own these properties and are always asking us these questions, how they can maximize using their real estate for their tax incentives that they hear either on a social media or they read articles about it but aren't quite sure how to do it. These are 3 items in the One Big Beautiful Bill that will really help. So we're really excited about that.
Yeah, absolutely. Huge opportunity for clients that have short-term rentals in particular to take advantage of this. And so that deduction can be paramount for them, particularly as you mentioned, Drew, if these are beach properties that are several $1,000,000 in value and cost to purchase. There's the opportunity to take accelerated depreciation on that through the cost seg study and get some massive deductions. And those deductions obviously save them taxes, and that tax savings can ultimately be reinvested elsewhere and hopefully continue to grow and compound. And so if you're watching this video and you're thinking, hey, this information is relevant for me, I wonder if I should talk to Instrumental Wealth and their team, message us through social media, hop on our website at Instrumental Wealth, schedule some time with one of us. We'd love to have a deeper conversation with you around this to see where and how you might be able to take advantage of the One Big Beautiful Bill and this certain provision in there. So thanks, everybody, and have a great day.